Hey folks, Dan Frio here the day before Thanksgiving. So not sure how many people are going to be watching this because a lot of people are just taking the day off and they're taking Friday off as well. So God bless you. So here's what we're going to talk about today, where mortgage rates are going and the whys behind it. So if you see right here, these are the top 6 programs people use when they're buying their first house. You can see that rates were just about 2 weeks ago, 8%. Now they're down at 7.375, so 5/8, almost 0.75% off of where we just were maybe 2 weeks ago. What happened 2 weeks ago? Well, the Federal Reserve stepped in and they said, we're not going to do anything with interest rates. We're going to watch the data. So what we do on this channel on a daily basis is we watch the data. We focus in on the things that the Federal Reserve looks at, because if the Federal Reserve would take their foot off the gas pedal, rates would start to come down a little bit. So without further ado, let's get over to the economic calendar because we have some data that came in today that might be a little bit more good news. Well, good news for the Fed, but not so good news for me and you. So let's get over to it. The first thing we want to talk about is right through here. Now, I opened up my calendar a little bit, or my economic data, to give us a little more data for today. So here, let me explain. Most of the times I just give you the caption that's basically the highlights of the day, but we need to dig in a little bit deeper today because what we want to talk about are 2 things. These 2 things are right here: core durable goods orders and jobless claims. Why do we follow this? Well, because jobless claims allows us to focus in on how many people are still working, how many people are losing their jobs, because the Federal Reserve, I feel like I'm a broken record, but the Federal Reserve wants me and you out of work, because if we're not working, we don't make enough money, so we can't be out there spending. Well, that's starting to come around a little bit, but when we focus in on the spending, especially core durable goods right through here, the economy is starting to crack. So let me explain a little bit to you. What durable goods orders are is right through here. So what durable goods orders are durable goods orders are the change in the total value of new orders for long-lasting manufacturing goods, including transportation items. Okay, so that's what durable goods are. Look at the numbers that we're seeing right here. Durable goods orders, core durable goods orders, the last reading, it was up 0.2%. So that means we're buying more and more, not that much, but we're buying more and more durable goods. Okay. Well, the expectations was it to ease a little bit to 0.1. It came in at 0. So people are not buying right now on this in this item. Then when you go to durable goods, so you can look at durable goods, it's basically the same thing, but they swipe out a few of the economic datas in there. But the last reading was 4%. It was supposed to come in at -3, from 4 to -3. It actually came in at -5.4. So it is cracking by the foundation. So what this is telling us is basically that people are kind of losing their jobs out there. The good news on the inflation front from the Fed is wage growth is starting to come down. Again, that's not good news for me and you, but that's good news for the economy to bring down prices. And that's why the Federal Reserve's doing what they're doing. They're like, the prices of things are getting way out of hand. We know it. You know, you probably went and bought, groceries for Thanksgiving, and how much more was that basket of goods that you bought this year than last year? It was astronomical. Okay, so we're starting to see some of those numbers starting to ease off. More and more people kind of losing their job and not making as much money. That's right in the wheelhouse of the Federal Reserve. Don't blame me, the messenger. I'm just explaining to you guys what's happening behind the scenes. So one thing other than this, we're starting to see people losing their jobs, not buying as much stuff as you can see here. But here's another thing we really want to take a focus in on. Here is how much money is in the money supply. This is what's called the M2 money supply. It basically tells us how much money you and I have basically in the bank. Okay, if you scratch this out, back to 2014, let me get my head out of the way for a second. You can see this is how our savings have grown as an economy over the last, 10, 15 years. So you go down through here and it's, where people were saving money. And then all of a sudden what happened right through here? Well, the pandemic. People start getting stimulus checks and other things. Now, guys, I get a lot of grief in the description down below. You're like, Dan, we don't have a ton of money. Well, guys, this is from the federal government. This is how much money is out in the system. This is how much it grew since the pandemic. It grew at the highest levels that we've ever seen in history. Okay, this is what caused inflation. But if you break it down now, what's happened over the last year, this is what's happening to the money supply. We were way up here. People are depleting their savings, going down and down and down and down. And all of a sudden there was a little reprieve, and now we're back down again. These numbers are also validated on how much money people are putting on their credit cards. So we have credit card debt at one point, I think $8 trillion, the highest that it's ever been. So people are running out of money and now putting it on their credit cards. And I think people are starting to realize, oh man, I really got to start tapering back on my spending. So that is great news when it comes to the Federal Reserve. So the next thing is, why is the stock market actually rising and why are mortgage rates actually dropping? Okay, here's a little bit of a dynamic that a lot of people don't talk about. What's happened over the last year and a half, you saw interest rates at the bank. So for example, your CD at a bank, you can get 5% interest rates on a CD at a bank. There's no risk. Basically, the bank isn't going to default. If they default, you have FDI insurance, so there's no risk. So you can get a 5% return on your money just putting in money in a CD. Well, as rates start to come down, you're seeing right here, 10-year treasuries are hitting a 2-month low. So that means a lot of these fixed security assets are starting to drop. So people are going to start selling treasuries and putting their money into higher yield items. They're going to push more money into the stock market. Okay, that's driving up the prices of stocks, and you can see the stock market's up every day. And that's actually going to start pushing money into the bond markets, such as corporate and mortgage-backed securities. So let me explain how this works on the mortgage-backed security side. And what is a mortgage-backed security? Well, mortgage-backed security is basically a mortgage bond that trades on Wall Street. That's yield is the biggest part of your mortgage rate. So as the mortgage-backed security bond prices, the prices go up, yields come down. So let me explain this to you. MBSs, that's a mortgage-backed security. It's a bond that trades on Wall Street. As people buy and buy and buy this, they push up the prices, okay? On a bond, the higher the prices go, the lower the yields or the lower the rates. So as people are moving out of treasuries, putting their money into mortgage-backed securities and other bonds for a higher yield, it's going to start driving the prices up and the yields down. A little bit more of a parallel between the 10-year treasury and the mortgage-backed securities. So that's what's going on. That's why you're seeing the stock market going up. People are moving out of those fixed securities. That's why you're starting to see mortgage rates come down as well, because people are taking a little more risk by buying mortgage-backed security bonds. So if you're out there and you're like, Dan, okay, here's where the rates are, and they're down almost 0.75% from where the Fed was 2 weeks ago. Wonder if I locked in. What can I do? Am I stuck? Well, if you're one of our borrowers, no, you're not stuck. But if you're at a bank or a credit union or something like that, you are stuck, because the bank, basically, they can't come back. You can't, it's like a stock. I'll say it that way. If you buy a stock, you own it. You're done. You can't go back to your broker the next day or a week later and say, oh, you know what, this stock price went down. Can I trade it in and now get a lower price, point on that stock? They're going to say, no, you can't do that. Well, that's the same thing that happens with your mortgage rate. Once you're locked in most cases, you're stuck. You're stuck with that bank. But is there a lower rate out there? Maybe there's lower fees. Maybe there's C, all the above. You can get a lower rate and lower fees. How do you figure out if you can? Well, great. Thank you for watching, because we can help you with this. We have a loan estimate tool right here. What you're going to do is, when you applied for a loan at a mortgage company or a bank, and they pre-qualified you, they're going to send you out a package. And in that package is going to be what's called a loan estimate. It's going to give us the purchase price of your home, how much you're financing, the interest rate, all the cost, is it locked in, all this other stuff. What you're going to do is upload that loan estimate into that tab right there. We're going to scan your loan with over 70 of the country's largest banks and finance companies to see, is there or can we get you a lower rate and lower fees, okay? But if you're out there and you're like, Dan, these rates are coming down, making housing maybe a little bit more affordable for me and my family. I would love to buy. I'm not saying you guys have to buy out there. It's your prerogative. If you're in a situation where you want to buy, we're here to help you. So how do you reach out to us for some help? Well, go to the rateupdate.com. There's 3 ways to get a hold of us. 1, click the Apply Now button. It's going to ask you a series of questions. Based on those answers, we're going to associate you with a mortgage specialist on our team that specializes in exactly what you're looking for. Or you can actually call us or email me. How do you do that? Well, scroll down to the bottom of our website. You're going to find blogs and other tools and mortgage calculators. But at the bottom of the website, you're going to see 2 things. You're going to see our 800 number, which is 844-775-5626. Or please feel free to email me directly, and I will be the one answering you. And many times I do it in a video form to just make it a little more personable. So how do you reach out to me? Oh, email me at dan@therateupdate.com. Thanks so much for watching, guys. I hope you learned something today. Have a fantastic Thanksgiving. Hope to see you next time. Bye-bye.